for 2012, Module 2. It's presented again by Mr. James. Okay, the problem was based on marginal costing and absorption costing. Okay, and the difference between the net operating income. All right, now one of the problems with this is it does not ask you for the budgeted or the actual. They give you two sets of figure, and they don't ask you for either one. They just say prepare marginal costing income statement for the company and absorption costing income statement. So what happened with this is some people went and they produced budgeted, and some people produce actual for the exam. Okay, but whatever you are doing, you should, if you have a situation like this, you should state what it is, which one you're doing, right? So what we'll do, we will prepare the actual. That we will be using these figures here, right? Because we are told how much they have in opening inventory and how much was, we can get how much was in closing inventory here. Okay, so Aqualad Limited produce orange juice at its factory. The following information relates to the production of orange juice for the period ended 31st March. We are given the production and the sales in units, and then we are also given the variable fixed and fixed cost for production and selling overheads. Right, some additional notes. The bottle is sold for $95. At the beginning of the year, you had 3,500 in opening stock, valued at 210. And this includes fixed overhead of 35, right? Okay, so we look first at the marginal cost and income statement. All right. The sales, we said we are going to do an actual, so it's 62,000 by 95, right? The actual sales here, 62,000, and the selling price 95. So we get 58.90 less the marginal cost of sales, the opening inventory 175. From this figure, how we get this figure? We take the 210 and we minus the 35 here, because for marginal costing you do not include the fixed cost in the production costs. Okay, and then we have the variable marginal production costs of 3,200. That is from here. Add them together, and then so there's something wrong with this figure here. The closing inventory should be 2,000, right? We produce this like that. Should be 2000 by 50. I wonder where I got the 55 from. And that will give us a figure here. I don't think it's 275, but we'll work with the 275. Okay. Marginal cost of sales would be 3100. 5890 minus that gives us the contribution of 2790. Then we have the fixed costs taken from here, 625 and 450. Gives us 1075, and the operating income would be 1715. Okay, so straightforward marginal costing statement. What I wanted to notice with these problems for Unit 2, they're not very difficult. Okay, once you know the concepts, like here, once you know the sales minus the marginal cost of sales gives you the contribution, and then from that you minus the fixed cost. Okay, you get your operating income, and that's at the end of the statement. Okay, now from this problem, as I said, it is possible to do a budgeted. It is possible to do a budgeted income statement using these figures as well. Okay, so if you're doing that, you'd say it at the top here, budgeted marginal costing statement, right? Okay, the question had asked for a marginal costing income statement, right? That's why I assume it was the actual because it didn't say budgeted here. Okay, but a student looking at this, it should be you're doing cost and management accounting. You usually deal with budgeted figures, and okay, you can do one for budget as well. Next, we look at the absorption costing statement, and again we're doing an actual. Income statement, we have the sales 62 by 95, it will remain the same. The production costs, the inventory, we have the full 210,000. We do not remove the fixed costs, and we can use the variable cost of production here, as well as the fixed. Okay, to get the total cost of production. So using the 32 and the 625 here. Right, now how did I get the 640? I use one figure. 620 fixed production overhead, okay, was absorbed at a predetermined overhead rate produced, right? Now the predetermined overhead rate, they didn't tell us what it was, so we will have to do it per unit, right? They didn't give us any other thing than this. So it will be the total production cost. It is 3,000. It would be 3,000. Let me just work that out for you here. It would be 3,000. 3 million, that is. Let me see. Okay, it's only the fixed production, right? So it would be 600,000, not the. Right. Okay, so this should be 600 here. Cross that out, put a 6 here. And divided by the number of units budgeted 60, right? And that is equal to 10. So it'll be $10 per unit, and you have 64 actual here. So that's how you get this this 640 here. Okay, I'm marking up this thing too much. Right, and now total production costs using absorption will be 4. Right, so when you're doing an actual income statement, you will use the overhead application rate to get the fixed production costs if they give you an overhead application rate, right? Minus the closing inventory. Right, 5,500 by 60. I wonder where I got the 5,500 from. Okay, 330. And notice I use the same figure here, so it didn't really make a difference in the end, right? The figure down here would be incorrect, but on both by the same amount, right? So 500 by 60 gives us 330. But it's supposed to be the closing inventory here multiplied by the marginal cost of 60. Okay, how we get this marginal cost of 60? Sorry, that would be thing again. It would be the 600,000 here plus the 3 million here. That gives us 36. Okay, now we divide it by the 60 here. Okay. So this 60 here is 3600 divided by 60,000. Okay, so the 36, right? So the absorption cost in here is using the total cost divided by the number of units. Okay, to get the POHR, and then you multiply that by the closing inventory, you would get your figure for here. And the less the, you would end up with overhead either being over absorb or under absorb. Okay, if you had more units, sorry, not more units, but more money budgeted. All right, that would be the difference between the actual here of 625 and the actual here multiply by the 10, right? Sorry, what am I saying? The 625 from the year 640. Gives us the 15 here. Okay, so the total here, which is this is the budgeted figure. This so the actual figure that is spent minus the budgeted figure, the absorbed figure, sorry, gives us the 15,000. Okay, but what you need to know here is the under or over absorption is, in this case, we have a over absorption. It is added on. I say that correct? We have a over absorption, so it is minus, right? If you had an under absorption, you would add it on. Okay, and we get the production costs of sales. From that, we take the sales and we get our gross profit, and we less the fixed selling overhead. If we had any variable selling overhead, we take it off here as well. We get our operating income of 1735. Okay, so recall where I got this figure from. All right, so when you are working it out, put in the correct figure here and see what it comes down to. All right, the reconciliation, if we take the profit from the marginal costing system of 1715, we add on the fixed overhead in the closing inventory, 55, and we minus the fixed overhead in the opening inventory, and we get the profit for the absorption costing statement. Of course, we could have done this the other way around by starting with this figure here and ending up with this figure. Let me change this. Ending up with this one here. Okay, so this would have been at the top, and instead we would add this, and minus this. Okay, we'll get 1715. But the main point to note here is that um, the reconciliation, the fixed overhead in the inventories is what causes the difference between the profits. Okay, now if we look at mine, although I messed up with the closing inventory here, right? The fact that I use the same amount in both statements means it still worked out, right? 1715 and the 1735 from here, right? Is what we work towards. And we had 35 in the opening inventory. We are given that here, right? 210 minus the 35. So the 35 is the difference. Okay, so your reconciliation, you just have to remember that the closing inventory is where, and the opening inventory is where what causes the difference. Okay, part B deals with a job costing, pretty straightforward, and right, we are given a job. You have 3 departments: machining, assembly, and finishing department, and the material required, we are given that, the labor. The production overhead is charged on the basis of machine hour in one department, labor hour in another, and finishing is on labor hour as well. A profit margin of 25%. Notice this is margin, right? Prepare the job cost sheet, calculate the quotation price for the job, right? Very straightforward again. The materials, we work them out, how much material you need. Right? The iron, in this case, we're using more than one different material. And we add them up together and we get the total for material. We do the same thing with the labor for the different departments. We work them out, add them up, and we get the total. Production overhead, we use the absorption base, 245 per machine hour. So the first one will be 245, first department, by 80 hours. Right? Okay, so 245 by 80 hours. machine assembly department 336 by 384, and that is coming from here. 384 comes from here, and 336. The finishing department, I have 4.6 per labor hour, and we have 184 hours at 280. So 184 by 4.6, and we should get 747 here. When we add the 149, 27, and 28, we'll get 385. Okay. Now we are told this is one of those questions where students, I believe they trick the students. The profit margin is supposed to be 25%. The 25% really is on this figure here. Right? So you have to convert this into the markup of 1/3 first and find 1/3 of this figure would give you this figure here. Okay? But if you want to find out the profit margin, it's really 25% of this figure would give you this. Yeah, so you look out for questions like that, right? Your profit is usually on the course, which means it is markup on the course, because you do not know this figure until you get this figure. Okay? But this figure is asking you for this here. Right? So look out for questions like that, where you have to convert the margin into the markup. If they give you the markup, well, you okay to go, you don't have to worry about it. You just calculate it on this and get that. This last part of the question, list 4 benefits of Akupa Limited activity-based costing. Okay, the benefits, it's identify the most profitable customers and the least profitable customers as well, least profitable products. It easily identifies the root causes of poor financial performance, tracks cost of activities and work in progress. How much they ask for? 4 benefits, right? So any one of those 4 would have given you a mark each. Accurately predicts cost, profit, resources requirement associated with the changes in production volume. And this is the main and most important one here. It eliminates the non-value added activities, right? If especially from the overheads, like here, if a product didn't use one of these departments, like if there wasn't anything to do in the finishing department, you wouldn't have to pay any of this. You wouldn't see this figure showing up in the cost, and down here, of course, your price would be lower. Okay. That's what it means by eliminated